Dear students, Insurance Management, Module number 4, Evolution and Types of Insurance. Insurance containing two major parts. One is life insurance, second one is general insurance. General insurance is a contract whereby upon periodic payment of a premium, the insurer undertakes to compensate the insured in the event of any specified loss or damage suffered by the latter. A typical characteristic of general insurance is that it serves only as a protection contract and not as an investment contract. It means the money paid as premium will come back to the insured by way of claims only on the occurrence of some specified events or risk resulting in loss or damage to the insured. That means general insurances gives only protection to the asset or property or business activities, but not act as contract of investment. General insurance containing several types. In that, first one is marine insurance. Evolution of marine insurance. It is oldest type of insurance, begins from Mediterranean voyage in 1347. It spread from Italy to trading routes in other countries of Europe. The Lombard merchants who settled in England brought marine insurance to England from Italy. With the introduction of steamship and growth of international trade, specialized marine service were introduced. Following this, the Lloyd's Association, founded in 1692 and originated from Coffee House, which run by Mr. Edward Lloyd, becomes the center of marine insurance world. Even today, the Lloyd organization forms an important part of British insurance market. The British opened general insurance in India around the year 1700. The first company was Sun Insurance Office Limited, which was set in the year 1710 at Calcutta. The meaning of marine insurance: a contract under which the insurer undertakes to indemnify the insured in the manner and to the extent thereby agreed against marine losses incidental to marine adventures is called marine insurance. It also defined as a form of insurance covering loss or damage to vessels or to cargo during transportation to the high seas. The document in which the contract is incorporated is called marine policy. Nature of marine insurance. First one, utmost good faith. Both the insured and the insurer must disclose everything which is in their knowledge and can affect the contract of insurance. That means both the parties should disclose all the material facts before signed for the insurance contract. They should not hide any material facts related to the contract. Second one, contract of indemnity. The insured is entitled to recover only the actual amount of loss from the insurer. That means the insured can claim for compensation after the incident and actual loss, but not more than the actual loss. Third point, proximate cause. It's covered by the policy only then the insurance company will be liable to compensate the insured. That means every marine insurance based on specific cause. When the incident happened and insured can claim with the proximate cause of the incident. Next point, essential requirement. If an insurance contract should be treated as or considered as valid contract, then it based on some essential requirements. Those are lawful consideration, free consent from both the parties, capacity of the parties are very important. Next, insurable interest. The subject matter insured must exist at the time of the loss. It need not exist when the insurance policy is taken. The owner of the ship, the owner of the cargo, a creditor who has advanced money on the security of the ship or cargo, the mortgagor and mortgagee, the master and crew of the ship are deemed to have insurable interest. The marine losses can be classified into two ways. One is total loss, second one is partial loss. The subject matter of insurance like ship, cargo, freight is totally lost. It is called total loss. The term partial loss is any loss other than a total loss is called partial loss. Now, scope of the marine insurance. First one, hull insurance. Insurance of vessel, a container and its equipments are included under hull insurance. Cargo insurance, cargo that means goods. Cargo insurance provides coverage against physical damage or loss of goods during shipping, whether by land, sea or on air. The cargo may be of any descriptions like wares, merchandise, property, goods, etc. Freight insurance. Freight is to be payable for the carriage of cargoes or if the vessel is chartered, the money to be paid for the use of vessel. The carrier is unable to earn freight if the goods or cargoes are not safely transported. Last one, liability of insurance. The marine insurance policy may include liability hazards such as collision or running down. The perils to be included in the policy are clearly defined and the insurer will be liable only for the insured perils. The different marine insurance policies. First one, voyage policy. The subject matter is insured for a particular voyage irrespective of the time involved in it. In this case, the risk attaches only when the ship starts on the voyage. It's called voyage policy. Time policy. The subject matter is insured for a definite period of time. The policy would cover all the risks from perils of the sea for the stated period of time. A time policy cannot be for a period exceeding 1 year. Mixed policy, third one, a combination of voyage and time policy and covers the risk during particular voyage for a specified period of time is mixed policy. Valued policy, the subject matter insured is agreed upon between the insurer and the insured and it is specified in the policy itself is valued policy. Open or unvalued policy, the subject matter insured is not specified, subject to the limit of sum assured. It leaves the value of the loss to be subsequently ascertained. Next, floating policy, a policy which only mentions the amount for which the insurance is taken out and leaves the name of the ship and other particulars to be defined by subsequent declarations. Such policies are very useful to merchants who are regularly dispatch goods through ships. It's very needful. Last but not the least, seventh one, port risk policy, a policy which covers all type of risk of vessel while it is standing at a port for a particular period of time is port risk policy. The insurance contain several clauses. Though the basic policies of marine insurance carries defined features and are issued as such along with standard clauses, but certain specific clauses may also be included to cater the individual requirements of the insured. So the clauses are following. In those clauses, we can expect 2 marks questions. First one, waiver clause. This clause is included in the policy to safeguard the interest of the insured and maintain that no act of the insured or the insurer mean to say recover or preserve the insured subject matter shall be taken to imply that either the insured intends to forego the compensation or that the insurer accepts the act at abandonment of the policy. Second one, sue and labor clause. The prosecute labor, that means sue, clause authorizes the insured to take all possible steps to prevent or diminish the loss or to protect the insured subject matter in the event of danger or any sort of risk. The insured is entitled to recover the expenses that may have been incurred for this purpose from the insurer is sue and labor clause. Third one is valuation clause. The value of the subject matter of insurance as settled upon between both the parties to the insurance contract is valuation clause. Fourth one, touch and stay clause. The ship is allowed to touch and stay only at such ports and in such order as has been specified in the policy, except in extreme circumstances or any natural calamities when it is essential to save the ship or the lives on board. Any departure from the route mentioned in the policy or the ordinary trade route followed will be considered as deviation. Fifth one, lost or not lost clause. In marine insurance, under which the insurer is liable to pay even if the insured loss has occurred prior to the effective date of the insurance. However, the insurer is not liable where the policyholder had knowledge about the loss at the time when the insurance was bought. Such clause is called lost or not lost clause. Next, Insurable clause. This clause covers the loss or damage caused to the ship or machinery as a result of negligence of the master of the ship or due to the explosives or underlying defect in the machinery or the hull. Such clause is called Insurable clause. Seventh one, FPA and FAA clause. That means free of particular average and free of all average clause. Free of particular average clause elevates the insurer of liability arising from particular average, and free of all average clause, the insurer is relieved from both particular average liability as well as general average liability. Next, warehouse to warehouse clause. This clause provides cover to the cargo from the time they are dispatched from the consignor's warehouse until their delivery at the consignee's warehouse at the port of destination. Next, point number 9, running down clause. According to this clause, it is used in hull insurance to cover the risk of damage arising out of collision between two ships, holding insurer liable to pay compensation to the owner of the damaged ship. That is running down clause. Next, free of capture and seizure clause. The insurer is relieved from the liability of indemnifying the insured for the loss arising due to the capture and seizure of the vessel. It is also covered under the war risk policy. Next, at and from clause. Usually used in OH policies, which covers the subject matter insured while it is lying at the port of departure and until they reach the final port of destination, that is at and from clause. Next, baratory clause. This clause covers losses incurred by the ship owner or the cargo owner due to willful conduct of the master or crew of the ship. Next one, Jettison clause. An act of throwing overboard a part of ship's cargo in order to reduce the weight of the vessel or to save other goods. Under these circumstances, this clause is used to interested parties to collectively compensate the loss suffered by the owner of jettisoned goods as a result of such acts. Last one, continuation clause. With this clause, the vessel is allowed to continue and complete its voyage even after the policy period has run out. This clause is generally incorporated in a time policy. The insured is required to give a prior notice for this and deposit a monthly pro-rate premium basis. So, we concluded marine insurance. Thank you.